Okay. All right. We got a little music. We're trying some things out today. I also have my. I don't know if there's a way to turn that down. Does that work? Let's phase it out. We're just going to test a few things today. Not a whole lot going on, but Fed minutes were released. Mortgage bonds did not respond in an ideal way, which makes no sense, but we're going to go through that. I also have some buttons here today. I don't know if it's going to work. I'm trying. It's just I don't have the same setup with StreamYard here, but we'll see how that sounds coming through the mic. The mic is not supposed to allow for those kinds of things, but we'll see what happens. So, Fed minutes are released. What does that mean? That means that when the Fed meets each month, or whenever they meet, they don't have to meet each month. It could be more often, could be less often. But whenever they meet, they make meeting minutes, notes essentially on the meeting, and then they release those notes to the public later. And I think maybe that made sense back in the day. Now they should probably just release them a little sooner, but it is what it is. These guys, it's the government, it's academics, they're just not, they don't understand that we understand in the real estate industry. Like if you're an agent, if you're a loan officer, if you're buying a house, you're selling a house, you understand like things move fast, we move quick. These guys move really, really slow. So here's what we're going to look at. We're going to look at what was said. We're going to look at the effect on interest rates today, which isn't as bad as mortgage-backed securities make it look. And then we're going to talk about what's happening with demand. A few key points, and that'll do it for today. But I do want to speak on this because I think there's a couple really, really important things that came out of this that alone are worth mentioning. If we talk about nothing else, if you take nothing else away, we've got a few things here that really good takeaways. Not just talking points, not just things to talk to your sphere about, but things that really, really matter. So let's look at this. So Fed sees more restrictive, and they use quotes here, and that's accurate. More restrictive policy is likely if inflation fails to come down, minutes say. Now, is this headline exactly what was said, or is it just the part that's in quotes? Let's look. Federal Reserve officials at their June meeting said another interest rate increase of 50 to 75 basis points likely at July meeting. So this month, we get another one. That's according to these minutes that released. Policymakers, now here we go, here's a big quote, recognized the possibility that an even more restrictive stance could be appropriate if elevated inflation pressures were to persist. So notice the difference between the headline, Fed sees more restrictive policy as likely if inflation fails to come down. But really what it was said was that they recognized the possibility that even more restrictive stance could be appropriate if elevated inflation pressures were to persist. So that's really what was said. Now, let's look at the effect, and then let's come back to this real quick because I think it might make sense. So the effect today was we lost 64 basis points. So not good, not ideal, not what we want to see, not what I was hoping for. We have seen a nice rally here, which we now have not even quite tested the bottom trend line. Maybe you could draw it that way. You could say, hey, we're testing that trend line there. So we're the uptrend is still intact no matter where you draw that line. I was hoping for sort of like a macro reverse head and shoulders. I really wanted this support level here to hold over here because I figured, we come up, come down, but if this support level holds, we got a really nice reverse head and shoulders, a big one that would be beautiful to see. The last one failed. They don't tend to fail more than 50% of the time. So if we could get another big one, that'd be great, which we still could, but it's not going to be as pretty. And we did come off support here. So that's good. But what was interesting about what happened today wasn't just that the uptrend held. It wasn't just that we lost 64 basis points. Remember, the last time the Fed raised rates in June by 75 basis points, we actually saw mortgage rates drop 0.25% that day. That day, mortgage rates dropped 0.25%. How? How can the Fed raising the lending rate to banks actually help lower mortgage rates? Because it's a sign that inflation is being attacked. Inflation is being put out. The water is going on to the inflation fire, and inflation is what bonds hate. So particularly mortgage bonds, all bonds really, but definitely mortgage bonds don't like it. So what the Fed today talks about tightening, and they're talking about, hey, we'll tighten if we need to. Why would that cause mortgage bonds to sell off? Furthermore, why would rates not change that much? I just quoted a conventional loan, 5.125, just now, after this. VA rates, we were getting into the low fours yesterday. Now we're mid to high fours, depending on credit score. But, we lost a little bit of ground there for VA FHA. Lost a little bit of ground for conventional too, but still not bad at all. How come rates didn't react worse? How come rates didn't get much worse? Remember what I was telling you? We were making this march up here. Rates haven't really gotten as better to the extent they haven't dropped to the extent you think they would based on this run. You think they would have gone up more or gone down more based on this run. And it just seemed like the banks know something, or they're hedging something. There's something going on there that we don't know about. But then today, when bonds drop, rates didn't move that much. A little spike, a little bit, but not as much as you would think, losing 64 basis points and testing the bottom of this upward trend. So I think that's good news on a couple of fronts. Number one, banks as a whole, remember I'm a broker, so I'm looking at dozens of different rate sheets. Banks as a whole are correctly playing this market. That is good. Everyone who's worried about a crash, the crash happened because everyone mismanaged it. Ratings agencies mismanaged it. The banks mismanaged it. Mortgage banks managed it. Everyone mismanaged it. It's being managed very well right here. I can tell you that for sure, at least to this point. Being managed very well right here. And also, why would this news, which is good, this is the Fed saying that we will continue to put out the inflation fire and we will take drastic steps if we need to. Why would that cause problems? There's only one reason. And this is the thing that I've been telling you about for weeks, months now. The one thing on my radar that I can see that itself alone would cause interest rates to go through the roof, and that is if the Fed begins to sell these bonds. So the only thing I can expect here, the only thing I can make sense of, is that the market saw this, and you know what? Don't give these traders that much credit, although they are smarter than us probably. You see a headline like that, more restrictive, Fed's looking to tighten. Hey, they'll go as tight as they need to. Well, that would include selling bonds, which would send mortgage bond prices way lower and rates way higher. But that's probably, I'm going to say it. I'm just going to go ahead and say it. That's not going to happen. The Fed's not going to sell bonds in this environment. They're not. Even though it would be a huge deflationary move, even though it would really, really, really lower housing prices if we had 8 or 9% mortgage rates, they can't be responsible for that. And the administration, would not want that on their watch either. So the politics are bad for that. The means to an end doesn't make sense if you're the Fed, because they're supposed to have white glove hands. They're supposed to have soft landings. That's the whole point of them being there. So just going ahead and creating a crash landing makes no sense. They're not going to sell bonds, but clearly the market was afraid of that today. Why is that good? That is good because very likely tomorrow, unless there's some truth to that, very likely tomorrow we'll get the bounce that we want higher. As people shrug that off and go, wait a minute, why were we worried about them selling bonds yesterday? So I feel good about that, even though we didn't have an ideal day. It's not ideal. It's not. But it's not as bad as it looks. Here's some straight facts. Even though we've been on this run, even though we've seen rates come down from their worst levels, mortgage demand, aka mortgage applications, still going down quite a bit. And I'm going to tell you that's probably going to continue to happen through the summer, I imagine, at least, maybe even into the fourth quarter. We could see that. Third quarter, I think you're going to see sort of diminished demand. You'll see, inventory is going to creep up a little bit as it has been. At some point, though, we will have more of a leveling off period. And I think that period is going to happen before the investors, like myself, for example, are waiting for it to pull the trigger to get something, in the investment property marketplace, which is where a lot of us are. A lot of the investor types have been sitting around going, okay, hey, if there is going to be an opportunity, I want to be ready for it. I know I've talked about how Meet Kevin has said that many times. And I know there's a lot of cash waiting on the sidelines. If the market were to come in, if there were to be a fire sale, if there was to be a panic of some sort, a lot of buyers with a lot of cash ready to get into this market, a lot of them. And also, not to mention, very unlikely that this would happen. But if there were a crash scenario, first of all, we would need a lot of fear. You need a lot of fear. You need people to be in a bad situation. You need people to be where they're forced to sell, right? If we're going to really have a crash, if that's what everyone out there seems to think, you have to have a situation, a scenario where people are forced to sell, where it becomes the only option they have is to make a bad decision to sell for a loss, right? And right now we have a lot of people in the best financial shape they've ever been in their life. We have record household wealth. So that situation, if it's going to happen, is not going to happen quickly. All right. And I want to put that part to bed. Like anyone who's saying crash in 2022, definitely not. It would take a sustained, economic pressure, job losses, lots of bad things would have to happen for a very, very long time, a year or two, to build up for the fear that would be necessary and the bad financial circumstances that would be necessary to actually cause a crash. And if we trickled sideways or even maybe a little bit lower during that time, it just reduces the possibility of that even happening. So I just don't have crash on my radar here. I just don't have it as something. I see there might be opportunities, and I've seen some people take advantage of them, and I'm looking to do so myself. But when the masses, as you can see here, you can look at the stats. I'm going to include this in the description. When the masses back off of something, that's usually when the Warren Buffetts and the really savvy investors, that's usually when they want in on something. When the masses are running towards something, that's usually when those guys are selling something. So just keep that in mind. Like which camp are you in? And who do you want to follow? Who do you want to follow? If it's the case that you're in a situation where this has happened a lot in recent days, where people are wanting to buy something, but they're worried about now not being as good a time to sell. Maybe I should wait until it's a better time to sell. Listen, if you're going to sell and buy a house at the same time, you're selling and buying in the same market. So if it's bad for you as a seller, it should be good for you as the buyer, right? If it's good for you as a seller, it's going to be bad for you as the buyer. As long as you're selling and buying in the same market, you really don't need to worry too much about whether it's a seller's market or a buyer's market. Just make sure whatever it is, you're taking advantage of it on that side of your two transactions. You don't need to try to time it perfectly. Well, we want to sell when it's a seller's market, but then somehow get a deal on our purchase. Just be realistic. Be realistic about it. And check out these minutes. It's somewhat boring. You don't need to watch this video. Not much there. But it's definitely interesting to see the minds of these academics, the way they look at it, the way that they framed it, and essentially what they're telling us. And we are completely in their hands. I mean, we are totally and completely beholden to these guys right now. We need them to not screw this up again. We need them to do this right. We need them to tackle inflation. We need those inflation numbers to start coming down. And when they do, I think we're going to be in great shape. We're going to be in terrific shape, in fact. But that said, rates are better than people think. Rates are definitely better than people believe that they are right now. And I would just implore you to do this. If you are a potential buyer and you're like, you know what, I'm not sure. I kind of want to stay on the outside of this market. I don't want to get into it. If you can put yourself in a position where you don't have a gun to your head. And what I mean by that is, go month to month on your lease. If you're living with family or parents or whatever, you're in great shape. Get yourself pre-approved. Take a look at the market and just watch the market. Just hawk it. Because if there are going to be deals to be had in this cycle, just know there's a lot of people looking for deals. There's a lot of flippers. There's a lot of investors. There's a ton of people, and the market's getting thin for them too. It's thin for everyone. So they're sitting there, they're looking at stuff. If you're going to get a good deal, it's not going to be because the market crashes and you sat there on your couch and woke up one day and decided to buy a house and got a good deal. That is not what's going to happen. If you want to get a good deal in this market, you need to be pre-approved. Pre-approval, you can update it if you need to, even if you don't buy for 7 or 8 months from now. But be on the lookout, and when you see that deal, you need to take it. You need to jump on it. Get after it, but you got to be ready to go. So if you really want to take advantage of a market that's softening, that's improving for buyers, that is how it's done. I'll give you a good example of that. And by the way, get a free loan quote anytime. Email me, call me, text me. Need very little information. I will hook you up. I'm a broker. We don't charge any lender fees. So, you can get the naked rate, as we call it. But that's the way you take advantage of this market, is you get yourself ready to go, be in a position to write an offer, because if a truly good deal hits the market right now, you're going to have to be fast. I just spoke to a listing agent buddy of mine. Last 2 listings that he had, let me actually just read you exactly what he said. How about that? I'll do exact quotes. You don't have to take my word for it. I said, hey, what happened? What's going on with your listings? He said, I got one listed at $2 million in Cardiff, and we're in contract for $2,060,000, so $60,000 above. And then got one in Oceanside, was listed at $750,000. They opened escrow at $760,000, but they had a backup offer at $780,000. You see what I'm talking about? So the people who got that property, and I would show you this text, but I'm not set up very well to do it. Yeah, I'm just not really set up well to do it right now. The people who offered $780,000 were too late. They were willing to pay $20,000 more than the previous buyer got an escrow for, but they weren't there quick enough. So while we talk about, things getting better for buyers, and they 100% are, it doesn't mean that we are in some crash scenario where buyers are just dictating everything. It just means that there's more opportunities. The primo homes, the ideal inventory, that's still getting a lot of eyeballs and a lot of action. Okay. So if you want to take advantage of that, if you want a piece of that, you got to be ready to go. Now, when we see things like tomorrow is going to be a very important day. I just want to show you what I'm looking at for tomorrow. Here, these minutes, when they get released, the markets do tend to react. But if you'll notice, rates ticked slightly higher in the 10-year today. Pretty much flat across the board for stocks. Pretty much flat for crypto. Although you see Ethereum there is up 4%. Gold has been getting hit, now down in the 1700s, which is interesting. Oil fighting to try to hang around that $100 a barrel range, which, by the way, is still really high. I mean, even though it's come down a lot, that's still really high. So but not a lot of action today, not a ton. But we see this big move in mortgage bonds. I think it's fake out. I think this thing is going to move higher. We're going to have to look tomorrow. Tomorrow's going to be a big day. If this trend line holds right here, then we're going to be in good shape. We did lose a couple support levels today, though, I will say. It took the 3rd level of support and the trend line to save us. So we needed that. Today. I remember watching this chart as this was going down, just like, goodness gracious, please stop it. But we held at the right point. So even though it doesn't look great, it's not ideal, we are still in great shape. Okay. That is it for today. Yeah, we're not going to look at crypto or anything today. I only have a couple articles for you today. Check out the description. If you guys need me for anything, you know where to find me. I'm easy to find. Give you a free loan quote. See if you're getting a good deal. If you've already got a loan quote, let's give it a second look. Let's make sure you're getting a good deal. Almost every single time. I want to say 95% of the time people send me the loan quote, I beat it by a lot. Not a little, a lot. Email, call, or text if you want to buy or refi. Just need a few pieces of information. We can get your loan quote right away. You guys have an amazing day. And I will be in touch soon. Actually, hold on a second. Okay, cool. All right, that's cool. All right, guys, have a good night.